maybe talk about your allocation, this kind of ballast potential for one's portfolio when including real estate broadly, and then you can opine on the tax advantages as your clients have enjoyed them through the execution of the program.
Yeah, I think it's a very interesting program that's seen a lot of success here since its first launch in 2017. And I remember being around and thinking this has got to be one of the biggest gifts and one of the biggest
Yeah,
advantages that has been awarded to those with concentrated positions. And eventually came to light that this was directly designed for those types of people. And we think back to how things were in 2017, and we there was certainly a dominance of tech that was prevalent in markets. But fast forward here, even since 2020, the S&P 500 has become so top heavy in tech, and rightfully so. But now the potential for the problem that QOZ legislation was we think really designed to kind of help alleviate that concentration risk. It's more prevalent now than ever, and so we're excited to have what appears to be an administration that's very real estate focused, that has quite an affinity for real estate. But as we look at kind of building out that destination portfolio for our clients, really look at kind of an order of operations type of approach, where if you want to build a puzzle, right, you start with the corners first. At least most of us do.
hmm
Um, and when you look at that and you try to find pieces of a portfolio that are going to look and feel very different, and again, that's really coming from twofold. One is which it's a different risk, right? Real estate and investing is more often than not a completely different risk set than investing in public equities. But on top of that is the return set as well. So where those investments generate a return source from, you think back over many periods of U.S. history when stock markets were flat or somewhat neutral, and you had great real estate markets. So there are times where both go down. There are times when they both go up. But in terms of finding those non-correlated pieces, they can usually be a very helpful place to start. And then as we're kind of navigating that three-dimensional challenge, right, is how do you move all these moving parts around, is one of the big, aspects that we also want to consider is, well, what tax benefits are out there? What is some low-hanging fruit that clients can potentially look to take advantage of? And so when you combine those two, the QOZ conversation is often one that we like to start with, because you kind of get that kill two birds with one stone, or insert your own metaphorical phrase there. But it begins to be a conversation that begins to say it's a very appropriate place at least to look. And as we begin to build out that destination portfolio, it's beginning to build those puzzle pieces around there, so that we're looking to both achieve a non correlation, a diversified portfolio, but also one with significant tax benefits and tax impacts. And as you start to look through, we call it our concentrated position toolkit. But as you start to look at all the available types of strategies and the benefits, the trade-offs, and really how to construct that, that's where I think the most value is had. There, you will never know if it was the right time, if it was the right thing to do, until you look in the rearview mirror. But we generally apply this with starting off with a dual rule set. Step one is you've got to like the price that you want to exit your position. Just as any good entrepreneur would, or any good business owner would, before you ever sell that company, you want to make sure that you're getting what you think is an appropriate value. And that can come from a number of different ways. But when we're looking at public equities, we're typically looking back at using technical analysis, using fundamental analysis, and a historical study of trend that's going to tell us and help to give us that roadmap that says, is this a good price? And if it is, at what point do we want to take action? Once we have that good price, we always say that it's our belief that you should never consider any sale until you have a destination portfolio in mind. Because the absolute worst thing I think we've seen with our clients over the years is if you make the exit and you incur a tax liability and you go to cash, and then the market continues to run, market continues to appreciate despite whatever risk may be out there. You've not done yourself a big disservice because you've diversified, but into a somewhat of a returnless asset. And so we always think that part of the early steps are to have really those two pieces very well documented and very well laid out to begin to number one, have your target price, have your target time, whatever that's going to be, and then begin to build out those cornerstones of that destination portfolio, and then continue to evaluate and continue to make adjustments as needed. As we know, the world is full of change. Markets are certainly follow that pathway as well. So, and as there is new legislation, as there are new rules, as there are new benefits that become more concrete, I think that even furthers that decision-making process to be able to help with the ultimate goal of making confident decisions that you'll look back on in a couple of years and say, yeah, I did the right thing. Even if the stock kept going higher, did I do the right thing by taking the opportunity that we had at the time and making a good educated decision and a good educated plan for your wealth and the client's family's wealth.